Welcome to Breaking News to Trading Moves. Usually when we talk about a medical diagnosis, there is this expectation of precision, like engineering.
Right, it is completely binary.
Exactly. You break your arm, the x-ray shows that jagged white line, and the doctor just points and says, well, there it is. Broken or not broken. It is a clean answer.
And it is comforting, you know? We like things to be visible, to be neatly categorized.
But then you step into the world of financial regulations and retail market access, and suddenly that x-ray machine is just broken. We are looking at a diagnostic landscape that is, well, honestly, it is murky.
Oh, it is the absolute definition of diagnostic muddy waters. I mean, the cause and effect are rarely a straight line here.
Exactly. So today we are analyzing the upcoming implementation of FINRA's new intraday margin standards. For over 2 decades, the financial industry operated under the pattern day trader rule.
The PDT rule, yeah.
Right, the PDT rule. It enforced a strict $25,000 minimum equity requirement for anyone wanting to make more than 3-day trades in a 5-day period. Now, regulators are replacing that rigid threshold with a dynamic, risk-based intraday margin system, which
Changes the landscape entirely.
it really does. And when you connect the dots between these regulatory transitions and the broader move towards zero-commission trading across brokerages, it raises a very pointed central question. Does frictionless, equal-footing access to the markets empower retail participants to build wealth, or does it merely expose them to an ecosystem optimized for their failure?
That is the million-dollar question.
It is. I will argue that removing arbitrary financial barriers and trading fees provides necessary market access, and it empowers retail investors to manage risk dynamically.
Then I will argue that the current retail architecture actively exploits documented human behavioral biases, turning access into a highly efficient mechanism for wealth extraction.
Okay, so let me outline my perspective first. Replacing rigid wealth thresholds with risk-based margin calculations treats retail investors as rational actors. For a very long time, that $25,000 barrier operated as a gatekeeper.
A very effective one, arguably.
Well, it essentially told the public, you must be this rich to participate actively in your own financial future. The new FINRA rules calculate risk dynamically throughout the day. They monitor the actual intraday margin deficit based on the specific volatility of the assets being traded.
Rather than just an arbitrary flat dollar amount.
Exactly. Furthermore, zero-commission trading, which is subsidized by mechanisms like payment for order flow or PFOF, operates as a vital tool. It removes the direct transaction costs that previously guaranteed mathematical failure for small accounts. Frictionless environments give working-class individuals the liberty to participate in wealth building on equal footing with larger players.
I hear what you are saying, but I come at it from a different way. The barrier to entry was certainly lowered, but the barrier to success remains insurmountable for the vast majority of people.
Insurmountable? That is a strong word.
But the data backs it up. Empirical data tracking global markets consistently shows that 70 to 90% of day traders lose money. I argue that combining zero-commission structures with gamified mobile apps and unlimited trades does not actually democratize finance.
So what does it do then?
It creates a virtual casino that mathematically and psychologically preys on retail participants. The entire architecture is explicitly designed to induce high-frequency trading, harvesting the retail order flow while the participants slowly, or sometimes very rapidly, bleed their capital dry.
I see why you think that, but let me give you a different perspective on the mechanics of zero-commission trading itself. Historically, flat fees were a massive drag on small accounts. Let us do the math on the old system.
Okay, let's do the math.
If you had a $500 account and you paid $7 to buy a stock and another $7 to sell it, you were down nearly 3% before the asset even moved. You were mathematically guaranteed to lose over time. Zero commissions completely changed that equation.
I am sorry, but I just do not buy that. Let me tell you why. Those trades are not actually free. They are funded by payment for order flow, which relies on the wholesaler model.
Right, the back-end routing.
Let us break down how that actually works. When a retail trader taps buy on their app, the brokerage does not route that order directly to the New York Stock Exchange. Instead, they sell the right to execute that order to a wholesale market maker.
Wait, let me make sure I understand this clearly, because I think the mechanics are crucial here. You're saying my broker isn't sending my trade to the public exchange. They are auctioning it off to a middleman?
Precisely. They route it to a wholesaler. That wholesaler fulfills your order, and they pocket a tiny fraction of a cent per share on the bid-ask spread, the difference between what a buyer is willing to pay and a seller is willing to accept.
Right.
In return for getting that highly predictable retail action, the wholesaler pays your brokerage a fee for sending the order their way.
But under the SEC's regulation best interest, those wholesalers are legally required to provide price improvement. They frequently execute the retail order at a better price than the public quotes available on the exchange.
A fraction of a penny in price improvement does not negate the underlying incentive structure. Brokerages earn revenue purely based on volume. The more you trade, the more they make. And it gets much worse when you look at high-risk assets.
How so?
Well, researchers at Wharton analyzed this and found that 2/3 of all PFOF revenue comes from options markets.
Let me jump in there. Why options specifically? Why are wholesalers paying more for that flow compared to regular stocks?
Because options inherently have much wider bid-ask spreads than blue-chip stocks. A regular stock might have a 1-cent spread, leaving very little room for the wholesaler to skim a profit. An options contract might have a 10-cent or 20-cent spread. It is far more lucrative for the middleman.
So there is more margin to capture.
Exactly. So, wholesalers pay brokers around 20 cents for every 100 shares of stock routed, but they pay substantially higher premiums for options routing. The entire business model relies on inducing frequent trading in the riskiest asset classes. The North American Securities Administrators Association, NASA, conducted a thorough review of this.
And what did they find?
They found that the house routinely reaps PFOF revenue while retail traders incur net losses.
That is a compelling point, though I would frame it differently. Consider PFF as a subsidy. It is remarkably akin to a free-to-use search engine.
A search engine.
Yes, a search engine relies heavily on back-end advertising revenue, but the user gets a highly valuable tool at zero direct cost. It operates on the exact same structural principle. The back-end payment mechanism does not negate the tangible utility of free trades for the retail investor.
I am not sure those two things are equivalent.
Well, let me ask you directly then. Is a system with direct fees somehow more moral if it locks working-class individuals out of the market entirely?
I completely reject the premise that the only alternative to a predatory free system is exclusionary pricing. Your search engine analogy assumes the user is just searching for information and retaining their autonomy.
They are retaining autonomy. They choose what to buy.
But in the market, a gamified brokerage app is designed to keep you clicking buy and sell until your account balance reaches zero. You aren't the user in this ecosystem. Your order flow is the product being harvested. Let us look at the actual empirical outcomes.
Okay, let's look at the data.
A comprehensive study out of Taiwan tracked performance across individual investors. They found that only 2% of day traders achieved consistent positive net returns over a 6-month period. Just 2%.
But let's pause on that Taiwan data for a second. That reflects a market with structural frictions that the U.S. market has largely eliminated. Are you suggesting that even without direct commissions, traders are still facing those kinds of losses?
Yes, absolutely. And the most crucial detail of that Taiwan study highlights exactly why. Even those top-performing day traders who grossed profits often saw those profits entirely wiped out by transaction costs and poor execution prices.
Slippage.
Right. In a zero-commission world, the cost is slippage. If you buy at a slightly higher price and sell at a slightly lower price thousands of times because of the PFOF routing, your account drains just as surely as if you were paying a flat fee. The math works against high-frequency retail trading.
I hear that, but I think you are looking at the wrong variable. It isn't just the execution math causing those losses. It brings us directly to the psychological component. If anything, removing the friction just exposes our psychological flaws faster.
Exactly. The psychology is where the damage truly accelerates. Researchers at UC Berkeley, specifically Terence O'Dean, have extensively documented what behavioral economists call the disposition effect.
Right, we are biologically hardwired to handle risk poorly.
Exactly. We tend to sell winning assets quickly to lock in the dopamine hit and cap our gains. But conversely, we hold on to losing assets far longer than we should.
Because selling a loser forces you to realize the loss. It makes the failure real.
Right. You are holding on to the losing stock to manage the regret. As long as it is unrealized, there is hope it will bounce back. We see this play out in real time constantly. Look at the r/real day trading community on Reddit.
I have seen some wild stories on there.
There is a heavily documented case study of a 28-year-old retail trader losing $26,000 out of their savings from an initial $5,000 account using leverage, entirely due to panic selling and an inability to cut losses.
Wow. 26,000 from a 5,000 base?
Yes. When the stock went down, they held and hoped. When it went up, they panicked and sold early to grab a tiny profit. They were managing their emotions, not their risk.
I acknowledge the cognitive hurdles. Bounded rationality is a very real phenomenon. The human brain has limited processing power and relies heavily on cognitive shortcuts. But I am not convinced by that line of reasoning, because we do not ban fast food simply because humans have a biological bias for sugar and fats.
But fast food doesn't bankrupt you in a day.
Sure, but just because our brains take cognitive shortcuts doesn't mean regulators should treat us like children. Traders can and do learn discipline. Overcoming the disposition effect is the initial learning curve of the market.
That is a compelling argument, but have you considered the broader behavioral feedback loops? There is a study titled Disposed to be Overconfident. Researchers found that investors selectively recall their realized gains while completely suppressing the memory of their losses.
Selective memory.
Exactly. It isn't just a learning curve. It is a mechanism that creates a dangerous feedback loop of overconfidence. Men, for instance, were found to trade 45% more actively than women, and consequently underperformed a simple passive buy and hold strategy by a much wider margin.
That is a well-documented disparity, yes.
Eating a hamburger does not instantly wipe out your entire net worth in a single afternoon. The cognitive traps in trading are uniquely destructive because they operate in an environment explicitly designed to exploit them.
I hear you, but bounded rationality does not justify paternalistic exclusion. You cannot force people to be smart with their money, but you also shouldn't lock them out of the market just because the learning curve is steep. In fact, if we look closely at the behavioral psychology you just outlined, it leads perfectly back to the FINRA rule changes.
How so?
The old $25,000 pattern day trader rule actually forced bad behavioral choices.
I'm curious to hear how a rule designed to limit trading forced bad behavior. Walk me through that.
Under the old regulatory realities, if a trader with a small account executed 3-day trades in a week, they were at their legal limit. Imagine a retail trader holding a tech stock. They've used their 3 trades. It is 3:45 p.m. right before the closing bell, and rumors circulate that the company's main supplier just went bankrupt. The stock starts sliding fast.
So they want to sell to cut the loss.
Exactly. But if they sold it to cut their losses, their broker would flag them as a pattern day trader because they made a 4th trade. Their account would instantly be frozen from opening new positions for 90 days.
Ah, the 90-day penalty box.
Right. To avoid that severe penalty, retail participants were actively forced to hold a losing position overnight. By holding overnight, they exposed themselves to serious gap-down risks. Let's say the company releases terrible earnings after the closing bell, and the stock opens 40% lower the next morning. The $25,000 rule forced traders to take massive, unmanageable losses just to comply with an arbitrary timeline.
I understand the mechanical trap of the old rule. Being forced to hold overnight against your own risk assessment is inherently flawed.
And the new FINRA intraday margin standards solve this perfectly. By calculating risk dynamically, a trader can immediately execute a stop loss on a falling stock, protecting their capital without triggering an account freeze. Removing the PDT rule actively improves a trader's ability to manage risk. It aligns the regulations with proper risk management principles.
But what about the predatory educators and brokers?
Yes, there are bad actors in this space. We saw India's financial regulator recently crack down on a 158 crore scam
involving a so-called educational trading school. They were pushing students into predatory brokerage accounts and feeding them illegal stock tips over secret Telegram channels.
Right, the pump and dump groups.
But marketing abuses are enforcement issues. They require regulatory crackdowns on the bad actors. They are not an indictment of the market mechanics themselves.
I come at it from a different way. You are arguing that because we removed a mechanical hurdle, the retail trader will suddenly execute optimal risk management. You are assuming the playing field is level now. To use an analogy, giving novice drivers the keys to a high-performance vehicle doesn't mean they are ready for the highway.
But that implies the only problem is their lack of skill.
It's worse than that. It isn't just giving them a fast car, it's putting them on a racetrack where the other drivers are algorithms that can see their steering wheel inputs a fraction of a second before they actually make them. The environment itself is adversarial.
It is definitely a tough environment.
And when you remove the barriers, the psychological and physical toll is severe. Let me explain the real-world physiological response to this adversarial racetrack. A study on day traders in Saudi Arabia documented extreme physical stress indicators during market hours. Shortness of breath, trembling in the hands, a fast heartbeat without physical effort, and high anxiety.
The physical stress of trading is certainly real, but surely that is a byproduct of risk-taking in any high-stakes endeavor, whether it is trading or starting a small business.
It is much more acute in leverage trading. And in Taiwan, researchers actually linked the volume of margin trading directly to stroke hospitalizations.
Wait, really? Stroke hospitalizations?
Yes. They examined the timeline and found that an increase in margin trading was associated with higher stroke hospitalizations, specifically on the 3rd and 6th days following the trading activity.
Why the 3rd and 6th days? That seems highly specific.
Because that timeline aligns exactly with the settlement periods and margin calls. When a trader buys on margin, they are borrowing money. When the market turns against them, the realization of financial ruin doesn't hit instantly. It hits when the broker demands the money back.
The margin call.
Yes, this triggers physiological panic, massive adrenaline dumps, and immense cardiovascular strain. The risk is completely asymmetric. Retail traders are competing against algorithmic execution and high-frequency trading, or HFT, systems. Studies on HFT profitability demonstrate that these systems operate at sub-millisecond speeds, detecting short-term informational advantages.
They capitalize on the spread.
They literally see the retail order flow and capitalize on those exact retail inefficiencies. A retail trader trying to manage risk against an algorithm is fighting a mathematically unwinnable battle.
But again, the trader has the choice not to engage in ultra-short-term scalping. They have the tools to position trade.
If their broker lets them. The NASA report also noted severe record-keeping violations at brokerages. Let's talk about Regulation T margin calls. A Regulation T margin call, for our listeners who might not have encountered one, is the dreaded notification from your broker.
Nobody wants that notification.
No. It happens when you are trading with borrowed money, your account value drops below the legal minimum requirement, and the broker demands you deposit cash immediately. If you don't, they start forcefully selling off your assets. NASA found that firms were caught canceling trades or moving them to error accounts just to hide these Regulation T margin calls from regulators. The infrastructure clearly prioritizes order flow revenue over customer welfare.
Let us bring these arguments together. I maintain that democratizing access is a net positive for the public. Replacing outdated, wealth-based gatekeeping like the $25,000 PDT rule with dynamic, risk-based margin policies provides retail participants with the necessary tools to actually engage the markets.
Even with the risks involved?
Yes, because removing the flat commission structures allows smaller accounts to trade without an immediate mathematical deficit hanging over their heads. Yes, the market is ruthless, but by removing the friction, it places the responsibility right where it belongs, on the individual. It is up to them to learn discipline, manage their own disposition effect, and utilize the liberty of the open market.
And I maintain that the broader market architecture ensures that increased access overwhelmingly translates to predictable financial detriment for the working class. The system is funded by payment for order flow. It is built entirely around wholesalers executing high-frequency trades.
And harvesting the data.
Exactly. And most importantly, it is perfectly designed to capitalize on hardwired human cognitive traps.
Lowering the barrier to entry into an environment that actively profits from your behavioral biases does not equal empowerment. It is just a highly efficient, gamified method of wealth extraction.
I think we find absolute convergence on one core reality. Day trading is exceptionally difficult. The environment is entirely unforgiving to those who are unprepared.
Yes, the vast majority of participants do lose money. The combination of structural market mechanics and human emotional vulnerability creates rigid psychological barriers that most people will never overcome.
Which leaves us with a critical reflection for our listeners. We encourage you to evaluate your own trading habits. Connect the dots between your personal psychology, how you physically and emotionally react to holding a losing position versus a winning one, and the structural market realities we examined today.
It is crucial to look at the motivations behind your clicks. Are you executing a planned risk management strategy, or are you reacting to the app's gamified interface?
We started by talking about that medical x-ray. We naturally want to think of a financial diagnosis as clean and binary, broken or not broken. But the diagnostic machine in the financial world is heavily clouded by back-end incentives and human nature. The regulatory barrier may have finally been removed, but the psychological barriers are as rigid as ever. We will leave you to form your own conclusions on whether the freedom to trade truly equates to the probability of success. Thank you for listening.